Thank you for having me here. It's a pleasure. As you can see, we're going to talk about the future of fintech, and to make it appropriate, we dated this slide tomorrow's date, just so you know it's the future. If you look at my last name and first name, you'll see that it probably doesn't look Irish to you. I'm not Irish. I can't really claim to be Irish. I'm Ukrainian by origin. And so Ukrainians and Irish have been compared a lot to each other because they sort of live in the shadow of a big empire. There is like this big neighbor that, somewhere that sort of in some way shapes your identity. Also very musical people, people who really are very talented in a variety of ways, very athletic, very musical, and so forth. And always trying to figure out just sort of what does it mean to be, to stay together. And so I'm very pleased to be speaking with you in front of this network, because that's one of the things that will actually come up today as well, is that this networking or creating this horizontal ties is something that is being more and more enabled by technology in the area of finance. Financial institutions over time and financial markets over time have concentrated and become very, very vertical. And now some of the technological innovations are breaking it up and creating these horizontal ties. So it will potentially resonate with you and create opportunities for people and entities and companies that were not a part of it before. To give you a little bit of background about myself, my research work has to do with the intersection of technology, finance, and regulation. There's some people out there who can be experts in two of those: technology and finance, or finance and regulation, or technology and regulation. Some of you are here. At least I've seen some names of law firms in there, and seen some companies that are really heavy on technology. That intersection of technology and finance and regulation is sort of difficult to be an expert in all three. And the way it came about is I spent a good deal of time working on policy issues, first with the International Monetary Fund, going around the world and helping countries set up capital markets. And then after the financial crisis in 2008, I joined the United States government, a regulatory agency called Commodity Futures Trading Commission, that was given by US Congress mandate to regulate over-the-counter derivatives, the instruments that were considered to be the culprit of the financial crisis. $600 trillion market in notional were given to the agency of 600 people with a $200 million annual budget. And so the whole agency had to figure out what to do about it. That's in addition to the mandate of overseeing futures and options markets in the US, and in addition to various enforcement issues, various enforcement things that needed to be done. So in the context of my being at the CFTC, I was the principal investigator of something called the flash crash, an event that happened in US financial markets in 2010. I worked on LIBOR on the enforcement case, and many other enforcement cases that I cannot tell you about. I worked on implementing the Dodd-Frank Act in the US. And as I was working on it, my colleagues from academia came back to me and said, "Andrei, you have the knowledge that we really need to bring back into the academic DNA, because we as an academic finance profession really overlooked the crisis. We were not out there sounding the alarm. We really need to be better at it. We need people like you with policy and regulatory experience to come back." And throughout, I stayed in contact with my network. We live on a global network of academics who work in this area. So my thought was, as I was working around the world and then in the US government, I became exposed to just how technologically advanced markets have become. Basically, markets now are computer farms. Humans are gone. There are no more humans. It's robots trading with robots everywhere. So all of these days of people gesticulating in jackets, no more, right? The enormously complex automated systems that do these things. And I also talked to institutions that were involved in a lot of these issues and noticed that institutions are automating too. In large banks, asset managers, they're trying to hire talent, and so technology is becoming so important for the finance. So first I joined the technology school MIT out of the US government, and then I moved here, which is sort of, I consider the MIT of Europe. And we're building up here really the capacity to understand these new paradigms. I will just briefly show you what it looks like, and you have a slide of one of the innovations that we're looking at that's come sort of under the umbrella of fintech, so intersection of finance and technology. So fintech, there are many definitions that people are thinking of just sort of what's fintech. One of the definitions is it's really application of digital technologies to the creation, transfer, and management of value and risk. The second bit is just a definition of what finance is, creation, management, and transfer of value and risk. And the first bit is tech, application of digital technologies. And it may sound kind of like it doesn't sort of, this definition quite do its justice. It's kind of like smartphone. Smartphone is not really a phone. It's a handheld computer that you can use from time to time to call someone, right? So it's not sort of a misnomer. So it's much more than a phone. So in this sense, so these digital technologies that are just sort of much more than just like sort of taking existing operations and making them substituting code for people in some way. It creates opportunities that were sort of not present before. Some of them probably completely not intended for use. For example, I've recently seen on the tube a young lady using her smartphone, the video camera in her smartphone, as a mirror to apply her makeup. Right? So that is presumably not what it was intended to do, yet you can do that. Right? You can now use this technology to completely substitute for something that was a completely static device used for one particular purpose, which is a mirror, just to reflect, with a device that now can be used for in a variety of ways, including this one. Right? And one of the things that, and that's one of the things that happens in this fintech, that people find uses for this technology combined with financial incentives and governance issues that previously were not possible. You have in front of you a slide that I'll get to right now. It's not intended to sort of for you to completely fully understand. It's more or less intended to sort of illustrate something that I'm going to talk about. It looks very busy. I mean, it sort of looks like a lot of things together. I'll walk you through this. And one of the when you hear about fintech, one of the words that comes up a lot is blockchain. So many of you have probably sort of read this word, wondered about it. Some of you have probably done some work on it or further reading. And for those of you, I don't really know just sort of what the audience composition is, so I'll just try to do it in the simplest possible way. So blockchain is basically a bunch of lines of code. So it starts out with the lines of code, which is open to anyone. Anyone could download these lines of code and become a part of some blockchain. So it's something that code enables you to participate, to communicate with others who are already using this technology, and be a part of it yourself. Some of it has to do with transferring information, messaging each other. Some of it has to do with actually enables you to transact in some way or enter into some relationships which are transaction-like. What's interesting about it, it's freely open. It's not controlled by anyone. It's sort of open code. You can go download it and you can become a part of it. The other interesting bit is that this code is designed using advances in cryptography in a way that communication and transfer of value between those who use this code can be enabled. So it basically designed in a way that you cannot cheat each other and you cannot cheat the system as a whole. And there are various, again, advances in computer science, math, and cryptography that are built into this. Something called the cryptographic hash function, something that takes a whole bunch of information and converts it into an indecipherable string of letters and numbers. Digital signature, something that enables you to digitally sign and establish that you are who you say you are. And what this technology does is that it enables basically participation on a very horizontal network among people who don't know each other and who don't need to know each other. But the technology is designed in a way that they can't cheat each other. And that gave rise to value. This is one of the interesting questions in economics and finance. Where does value come from? What makes something valuable? And how do you hold on to this value, right? And it is known that, sort of on the other end of it, that if something could be, lost, stolen, misappropriated in some way, that it becomes less valuable because it could be taken away. So that part is just sort of established by this technology. What gives value per se is not entirely clear. Like something, you go to some of the examples of, people start going back to the basics and start trying to understand, why some forms of money are valuable. What are the functions of money? What is the function of value? What's the function of risk in this technological space? So really a lot of thinking started going into this. And these are some of the questions that remain unanswered. Yet the value is there. The blockchain was the most well-known blockchain, and I'll describe why it's called a blockchain, is part of a Bitcoin protocol, so Bitcoin, cryptocurrency Bitcoin. So what these blockchains are is that these are literally blocks of transactions in Bitcoin. It could be anything, they don't have to be transactions in Bitcoin. They could be communications among participants. They could be land registries. They could be outcomes of a voting process. They could be minutes of this gathering. They're strung together in a sequential way, and so in a way that cannot be tampered with in the future. So let's say we completed the minutes of this meeting, and then we put it on the blockchain, and at some point later, 3 months later, somebody wanted to say, it wasn't Andrei speaking at this meeting, it was somebody else. You cannot go and alter that record. Some of the sort of metaphorical ways of describing blockchain is royal genealogical trees. A royal genealogical tree is a blockchain. It starts out with some founder tutor, and then that person has an ancestor, and that person has an offspring, and then that person has an offspring, and that person has an offspring, and so forth. And they're linked together. And basically, you can see immediately what potential issues could be with that. One of the potential issues is that this sequential nature of it has to be somehow agreed upon, that this is the sequence that all the participants on this blockchain network agree to. And that is done in the form of using the so-called consensus mechanism. There are different consensus mechanisms. And then, if we agree that that is the case, then the additional block could attach to that. As also from history about sort of royal ancestry, if there is a disagreement about which block follows what, in the past it gave rise to wars that lasted decades, when some people said, well, this is the royal ancestor, and other people said, no, this is the one. And then these sort of fractions then just fight each other until one of them wins and says, okay, ours is the ancestor. You can also see that it could give rise to a loss of value, just like in this case, and the conflict could give rise to a loss of value. So a lot of these issues still need to be technologically solved. But the potential of this crypto technology that could hold value and not let it be stolen, misappropriated, and in some way tampered with is manifest here on this slide. This is a slide prepared by First Partner. It's copyrighted by them, so it's just for your informational purposes, of what people have been doing with and experimenting with and investing into it with this technology as a founding block. You can see various names and logos of large companies that are intended to illustrate that this is not just, it's way beyond a bunch of people sitting in the garage tinkering with this, cool protocol. And sort of a variety of, you can see numbers on the left-hand side about actual money being invested into developing this protocol and putting it to some use. Again, remember, it's open from the start, so no one owns it. So you can't own it. But what you can do is you can take this protocol and you can build on top of it. So if you can think of blockchain as an operating system, Linux, that is not owned by anyone, but you can build on top of it something that you can then try to sell. So what are the things that are in the works? One of the big areas in which people have been looking at is clearing and settlement. So clearing and settlement post-transaction part of trading in securities or in derivatives or in fixed income instruments has become very complicated and very expensive. It also runs on the sort of its own chain that involves a variety of intermediaries that have to do it. Clearing houses, clearing members, custodians, and everybody just sort of takes a piece of this business. Regulators regulate how it needs to be done. And it runs on lines of code which are, in principle, not integrated with each other. And so from all the time, there are working groups working on, let's make this code somehow unified so that we can all participate in it. Because remember, everything is automated here. All of these processes have automated. No more humans doing that. Let's come up with a language that we all agree to. And then somebody sort of immediately deviates from it and say, well, I want to rebuild my system, and this is the system that I designed, and this is the language that we speak here, and there's some dialect develops. And so, there are all these dialects that are sitting inside of the system, which makes it very expensive to run. There are some estimates of how expensive it is to run this clearing and settlement networks. And then all of a sudden, blockchain appears, free technology that is immediately global, not owned by anyone, common universal language that holds value, has the potential to basically leapfrog all of this, let's agree and, to be friends thing and just say, let's just use this technology. And a number of consortia arose out of this. Various banks, asset managers, exchanges came together and said, well, let's put money into this. Let's develop proof of concepts, and let's see, maybe we could capture some of this business. Again, people who are business-minded are always trying to think of, how do I put a toll on this and start charging fees? Okay, this is all free. This is a free road. But what if I can put a toll and start charging a little bit of a fee, because that could become a cool business model. And so far, none of these business models have become operational, because the technology is inherently designed to be free, open for anyone to use, and outside of the sort of the regulatory system. It's designed to be outside of the regulatory system from the start. So people are experimenting, trying to figure out how they can make money off of it and what kind of value proposition that they're going to offer on this. It all looks to me some variety of I put a toll and I'll charge you fees, right? So whereas with free technology, it's kind of like, okay, you have your toll and you're trying to charge me fees. I'll just take a parallel street, which is free. So what's the point of doing that? Other things that people have experimented with is payments. International payments, global payments go over the same fiber optic cables that you and I use when we send our email messages. When we send our email messages, they're free to us. Why do we need to pay £30 or $30 to send in, something from London to New York? What is it for? Like, is it being carried by a pigeon? Like, why? It's going over the same fiber optic cables. It goes from my account to some other established account. So there is no know your customer, anti-money laundering, or any of this business, right? So why does it take 3 days and cost so much money? Why? Because people are charging toll all along the way, and and a variety of companies, startup in this case, were set up to circumvent that, to create an environment in which you can transfer money, again, from an established account to an established account for fraction of the money, for pennies, really, pretty much instantaneously, within 10 minutes. That seems to make sense. Obviously, large established players hate this idea because, all of a sudden there is sort of a business model that's being completely disrupted by technology. But from the point of view of just sort of greater welfare, it's a good thing. One of the areas in which this is particularly prominent is remittances. Remittances, lots of people around the world work outside of countries in which they were born and send money to their relatives, to the country, to that remains still in that country. Their elderly parents or their wives and kids, for whatever reason, stay there. So hundreds of billions of dollars are being transferred, and it needs to go that way. It's not like it's not fluff, right? I mean, it is something that value has been created somewhere, needs to be transferred, and why should it be charged lots and lots of toll fees as it's being done, right? So remittances is one of the areas in which there have been a lot of interesting innovations. There's also been innovations using this technology with something that not entirely transfer of value of risk, but creation of instruments on top of blockchains, issuance of securities immediately on the blockchain rather than the custodian institutions. Several exchanges, and most notably Australian Stock Exchange, has come out and said that they're actually going to implement it within a year or two. That again is in principle revolutionary because it changes market design. It changes how The market is designed from the start. What people are waiting for in this space is something even more interesting and revolutionary, and that is something along the lines of a company like Uber or Airbnb issuing its stock to anyone who uses it directly on blockchain, circumventing the exchanges, not even using any of the established exchanges. So imagine that. So now you can buy, say, your share of Uber directly from this technology and participate in the cash flows of Uber, not just as someone who uses it or a driver of it, but as an investor now in it. Completely horizontal. You don't need to go through, any exchange or any broker dealer in this. That could be really quite revolutionary and give it a big start. And it's not a dream, it's sort of it is being discussed. And many other just sort of areas in which it is being considered. So the main aspects of this and sort of the main sort of illustrative aspects of it is a couple of things. One is that it's a technology that enables interactions among participants, sort of takes it further, this interactions among participants, in which who the participants are is not important. The math and crypto technology just sort of makes it work. It's a sort of a next iteration in finance after the big iteration, after the concept of, potentially after the concept of fiat money. So what fiat money enabled us to do is exchange value without really knowing who we are, trusting each other, because it's protected, again, by printing technology. The new 5-pound bill that you've seen is probably revolutionary in terms of the way it's designed. I mean, it's very, very difficult to forge something like that. Yet, it might well be the last bill that the Bank of England would care about to design, because they've been talking about issuing pound digitally and creating digital pound accounts, first for financial institutions, then for non-financial institutions, then for individuals. And so in principle, individuals would be able to hold their accounts with the Bank of England. And then all the other banks would compete for the provision of services to these accounts. So you don't need to hold your accounts and services in the same bank. Think of how much regulators would love this, because they don't need to bail out banks anymore. You don't need to bail them out. It doesn't matter. One of them goes down, money doesn't go anywhere. It stays with you. You don't need to have deposit protection schemes. You don't need to go and figure out these complex risk models, proprietary trading of whatever these banks are doing. They cannot put your money at risk anymore. Your money stays with you at your accounts in the Bank of England. Think of it also this way. Every penny of this digital pound is known at any point in time where it is, and the entire history of it is known. Where it's come from and where it is now. So if you want to do something along the lines of monetary stimulus, you can be very, very specific. One of the things that could be issued on this blockchain is something called smart contracts, contracts that operate under very specific conditions. You can have a smart contract. You can say financial institutions that lend to particular types of individuals in a particular suburb of Manchester get paid this interest rate. You can be extremely surgical with what you do, as opposed to creating quantitative easing programs that end up with entities like BlackRock that grow in value from $2 trillion to $4.5 trillion. And the rest of the economy grows at like 0.2%, right? This money just sort of flows the enormous asset managers and bypasses the economy. So lots of interesting things that are being considered by these technologies. Regulators are looking at it. Disruptors are looking at it. Finance professors are looking at it. And these are exciting times. I'd like to open this for questions if you have some.